Hello, last time I stood here talking to you about Soilbuild Business Space REIT. They just announced the acquisition of number 72 Loyang Way, the Technics building in the east of Singapore. Well, here we are 12 months later, and that turned out to be the only acquisition they made all year. $97 million worth, financed, as we found out in May, through a $90 million share placement. But that doesn't mean to say that there isn't much to talk about with Soilbuild Business Space REIT, because quite a number of issues would be concerning shareholders ahead of the annual general meeting. And let me take you through some of those points. First of all, let's have a look at the earnings as they announced them. This is the gross revenue number, which you can see on page 6. And on page 45, you can see that most of this increase that we're seeing here, a 16% increase, was due to the fact that they bought new buildings. So what's important there is to note that it wasn't like they were getting a lot more rent from their tenants. It wasn't on a same-store basis, I guess you could say, the increase wasn't that much, as you would read on page 45. Net property income was up by 18%. Income available for distribution, you see here on page 6, up by 15%. And so the distribution per unit, again, partly because of this private placement, presumably up by only 5%. So those were the positive numbers, and the charts all look great. But as with any real estate investment trust, you need to be concerned with a couple of things. The first is the state of the economy, which then flows through to demand for the space, which then has an impact on the amount of money that tenants are willing to pay. And because the assets of Soilbuild Business Space REIT are about 50-50 split in terms of where the revenue is coming from between their multi-tenanted buildings and their 2 business parks, 11 buildings in all, obviously, these are going to be important. The portfolio occupancy there, as you can see, has already slipped a little from 100% a year ago to just under 97% this time. That doesn't sound like much, but I guess is indicative of the sort of trend that we're seeing, as you'll see as we go through these charts. On page 6 is where you can see this chart, but further down you'll be able to read about the number of leases that have been renewed. 72.7% recorded a positive average rental reversion of 2.5%. In other words, 7 in 10 leases were renewed at, on average, 2.5% more. 12 months ago, it was 9.8% more. So you can already see that not only is occupancy down, but they're also unable to increase the rent as much as they did in prior years, all part of this picture about the softening demand for the industrial space that Soilbuild Business Space REIT owns. They did lease out 300,000 square feet of new leases in 2015, so it's not like they're not able to lease out the space, it's just that the market is a bit soft. 1 in 20 leases were not renewed, about 5%. The non-renewals at West Park Biz Central and Tuas Connection, they say, were mainly attributed to the tenants downsizing their operations or even moving overseas altogether. Now on page 56, we get more of an overview of how the industrial space market is going, and you'll be able to see how this picture kind of comes together. Let's firstly look at this chart here, the bar chart, which shows that the business park stock, yes, the orange bars keep rising, in other words, more and more space is occupied, but you see the green bar on top is down just a little bit on last year. So in a sense, this is good news because it means that there isn't quite as much space unoccupied, vacant, as there was in 2014. Good for those 2 business parks that Soilbuild owns. On page 57, though, you'll see the multi-tenanted factories, where we see not only the amount of space occupied there in orange increase, but the green bar is also the biggest that we've seen in at least 10 years, at least going by this chart. So quite a lot of space available, all indicative of this soft demand. When we then turn our attention to the weighted average lease to the expiry, in other words, the amount of time left before the leases expire on an average basis, you'll see here on page 6 that it's increased to just under 5 years from less than 4 years. That should be good news. But again, let's look through that into a little bit more detail. 2016, we've got around 12-13% of the net lettable area, according to this chart, coming back onto the market. In other words, the leases expiring. 2018, that's going to be a very substantial percentage indeed. And you can see how those bar charts are growing. The orange bar, by the way, is the lease profile by gross rental income. So even though in 2018 we have, net lettable area, you can see, is expiring, the bar is growing, but the impact that this will have if they're not able to renew those leases or at the same rents is going to be proportionately bigger. One other thing that I thought I'd point out about the soft industrial space market that we're in is whether the tenants are actually paying on time. So it's not just, can we fill up all the space? Can we renew those leases? But do the people who occupy the space actually pay their rent on time? And on page 121, you can see that the overdue leases has actually grown quite substantially. You can see that in this table, and it might be a little bit hard to see from where you're sitting, but read the annual report for yourself and you'll be able to see this chart. And what it says is that the receivables overdue rental has crept up to 1.4 million, up from only $250,000 12 months ago. So one thing that you might like to ask at the AGM is, are the tenants having trouble paying their bills in line with this picture of economic softness that we're seeing? The Chairman and Chief Executive, Roy Teo, and Chairman Cheong are commenting in very sober terms about the outlook on the market. They say here on page 9 that Singapore's industrial property sector remained relatively soft in 2015. There's that soft word again, dampened by the high supply of industrial space. Nonetheless, business park and high-tech industrial sectors exhibited better fundamentals with stable to positive rental reversions. Stable to positive, remember I mentioned 2.5%, down from almost 10% last year. So I guess that's what they're talking about. And then I've highlighted here this particular line. I thought this was probably the most important line for shareholders to read as you read through the entire annual report. The challenge for 2016 is to renew and re-let the multi-tenanted space that expires in the year amid a softening market. And once again, there's the word soft. You get the picture. On to the debt situation, and again on page 6 you'll find this aggregate leverage table showing that leverage that is debt has crept up just a little bit. So what this in essence means is that they owe 36 cents for every dollar's worth of assets. The limit is 45. And on this chart here on page 48, you can see that that debt is actually due in 2018, or at least a substantial part of it, 57, almost 60% of that debt. And that consists of the medium-term notes and a variety of other debts that they have on the books. So it looks like 2016, we're going to see some softness. 2018 is going to be particularly important because of, first, the number of leases that are going to be coming up for renewal and the amount of money that they'll have to repay in that year. And those are the sort of things that you can ask management about when you see them at the annual general meeting. Here are the details. Thursday, 21st of April, 2:30 p.m. at Suntec City Convention and Exhibition Centre.